Welcome back again, friends. As always, this is Erik Brown, your local Beverly Hills and Los Angeles real estate agent, sharing with you the best of LA, where we go through some of the best and brightest as Los Angeles area businesses have to offer. And today, I'm with my friend Mark Maimon, and we're going to be talking about the three big things that you need to know about the mortgage industry today and how it's going to affect the world that we live in moving forward. Mark, great to see you again.
Thank you, Erik. Thanks so much for having me. Yeah, it's an interesting time in the mortgage industry, to say the least.
I can only imagine. And so we'll dive in and unpack that a little bit, and I'm going to let you kind of take the stage. So why don't we begin? Share a little bit about your background with the audience, your company, sure. What brings you here today?
Sure. So my name is Mark Maimon. I'm a senior vice president at a company called NJ Lenders Corp. And I've been in the industry 20 years. I started my career in New York, but then kept a team of people there, but now I'm based in LA since 2008. And I'm all in with real estate. So I do obviously mortgages. I love to acquire and rent out properties and do Airbnb short-term rentals up in Lake Arrowhead and all sorts of stuff. So I have my hands in as many things as I can possibly get them in.
Well, you are the guy to absolutely talk to then, since you see so many different buckets in this world. So why don't you start off and give us a little bit of, as you had said, a state of the union of where we're at today and where we're going.
Sure. So the hot topic right now, it's all over the news, maybe to a fault, is the state of interest rates and where they're going, how it's affecting the market, how it's affecting buyer sentiment and the drive to acquire properties. So in my personal opinion, recording this video in the very beginning of December 2022, just to give it a frame of reference, I think we have now hit the peak with the current interest rate cycle. So we recently saw the CPI index, which is the inflation reading that the government puts out every month, finally start to level off. And we've seen some other reports that make it seem like that is going to continue. And as inflation goes, mortgage rates go. So as inflation was rising, interest rates were rising. As inflation starts to cool off, we will see interest rates start to cool off as well. There's a very direct correlation, even though it's not necessarily tied to each other, they move absolutely in unison with each other. So what I think a lot of people don't understand about inflation, not to get too technical, is that these readings are based on a 12-month window of time. So if you go back just a little over 12 months, we had periods of time where inflation was not an issue. And so what was happening is it makes it look, when you compare 12 months ago to today, it makes it look like a very steep curve with inflation. That's why interest rates rose as quickly as they did and as much as they did. So using Fannie Mae loans, which is not really our bread and butter, probably not most of your clients either, Erik, probably dealing more in the jumbo space, but just as a benchmark, those interest rates went from just below 3% to over 7% at the peak. So that's a very sharp change for sure. So now that we're at the point where the most recent 12 months period is full of inflationary months and readings, now we start to see that leveling off of the curve. And just as the most recent report came in mid-November, we started to actually see the rate of inflation decrease. We saw an immediate decline in interest rates as a result. And I think that trend is going to continue just based on this 12-month running average of how these reports are generated. So most people don't understand the technical nature of those reports. It's not just the reading itself, but it's a comparison of the last 12 months. And that's an important factor because we are expecting it to cool back off. So our hope is that interest rates are going to be coming down. It's not going to be a drop off the cliff. All of a sudden they're back to 3%. It'll be a slow gradual, just like anything with a bell curve. There's a curve to it. So, but we will start to see interest rates decline, and most industry experts are expecting rates to decline by a good 1% to 2% going into 2023.
Well, what's so interesting, and you can speak to this, you and I have been in the industry about the same amount of time, is we've been coddled, like sitting at 3.5, under 3% interest rates for the longest of times. And now we're at a rate that historically is still not considered that bad. I mean, think about the 70s and 80s where interest rates were and where we're at today.
Sure.
Everyone is assuming that the sky is falling.
Yes, it's all a matter of perspective, because what we found is that clients of ours who got pre-approved in late 2022 are coming into this market. They're like, I'm not going to buy because the rate was 3%, now it's 7%. And some people just can't qualify anymore. So there is a segment of the market that is now somewhat priced out because prices haven't really adjusted so much, but the interest rates are higher, so it's harder to qualify at that same price point. So it's a matter of perspective. So our clients who have bought, many properties over the years, maybe they bought their first property in the 80s when the interest rates were at their highest at around 18%, all have this perspective that, 5, 6, 7% is still a great rate. It's the people that are entering the market for the first time or maybe the second time who have never seen that cycle of higher rates and, just expect that interest rates are always going to be around 3%. It's just not sustainable forever. So right now we're pretty much in line with historical averages, maybe even a little below. So having that perspective is important, but it's also a matter of people focusing on the monthly payment. I think most consumers get very hyper focused on the rate. What's the rate? What's the rate? But what actually affects you is the payment, because the less you're financing, for example, the less that higher rate is going to affect you compared to somebody who's financing twice as much. So we always encourage our clients to pay more attention to what the monthly payment is as opposed to the rate, make sure that it's affordable for them.
Well, and I think that segues really well into any time that there's some level of fluctuation in the marketplace. And we can look historically, every 10 plus or minus years, there's some type of adjustment that will happen that's larger than the things that happen in a given quarter or a given year. And so we're presented with some opportunities now that not enough people are talking about. And so again, on the finance side, what are you seeing there?
Sure. So I'm involved in the investing community myself, both for my own benefit and also for the benefit of our clients, being able to take advantage of the opportunities. While primary residence buyers are getting a little skittish, investors are poking their heads up and they're getting excited because this issue with higher interest rates is temporary. It's not going to last. It's going to cool back off as inflation gets more under control. So if you're able to buy now, potentially with more negotiability, you can maybe get your contingencies, things that you couldn't even think of, 12 months ago. Now an investor can come in, acquire that property at, more reasonable terms, whatever that may be, whether it be price or contingencies or inspections, whatever it may be, and take advantage of that entry level point and knowing that they're likely to refinance that loan within the next 12 months or so. Obviously, there's no guarantees of exactly how long that curve will take to materialize, but I'm pretty confident that anybody taking a loan this year is going to be refinancing within 12 to 18 months. Yeah, so the investors are definitely poking their heads up and getting very excited.
I've been giving that example here in Los Angeles. We're hovering, I think the county average for price point is a little under $1 million. So if we just take that as a round number, back in the beginning of the year, someone was competing against 5 to 10 offers or more, and typically going somewhere between 7 to 10% over asking price. So if you're putting down $200,000, your loan there is $900,000. Whereas today, that same property at $1 million, you're not getting it for 1.1, you're maybe getting it for 950, plus the contingencies that you mentioned. And now all of a sudden you look at your balance difference of 150 grand, that's sizable. And not enough people are talking about.
No, and especially considering the fact that you might get in at that lower price point and then be able to refinance to a lower rate within a year. So it's like cake and eat it too. But for some reason, buyers aren't getting that. So we're doing our part. And obviously this discussion is part of that effort to get word out there to say, buyers, don't miss this opportunity, because investors know that the best time to buy is when other people are nervous to buy. Right? Because you can get all these benefits that you can get during these times that, a year ago, you would, like you said, you'd have to go 7 to 10% over asking, sometimes even more, and compete against 20 people. Now you're not necessarily doing that in the same way. So take advantage of the lower price. Then from an investment standpoint, you lower or improve your cash flow by lowering your mortgage payment when you refinance. And now you are golden. This is the type of times when investors make a lot of money, is when other people are potentially running for the fences. I don't think LA is affected in the same way that some other markets are, because it's a monetary center. There's money. People want to buy, they're going to buy. They have disposable income for the most part, not everyone, but on average. So I think the market here is affected less than it is in other places. But investing, you're not going to live there. So you could invest in other states as well as California. All my personal investments are in California, and I think we've done really well with them. But I am personally looking to acquire wherever I can for that exact reason. Not scared about the fact that it might cost me more money to get in on my mortgage payment, knowing that, or feeling confident that I will be able to lower that cost and then benefit for, the next 30 plus years.
Yeah. Well, and as the old saying goes, that necessity is the mother of invention. And you and your company have done such a great job of implementing or instituting new products that are out there that are available not only for investors and end users and consumers and residents, et cetera, that makes it more palatable and competitive in today. So it might be worth you sharing a little bit about some of these products that are now available.
Sure. Yeah, and California is very friendly to creative loan products, more so than other states. So some of these great products are available in California, but not elsewhere in some cases. So there are products, for example, let's start on the owner-occupied side, and then I'll talk about the investor side. There are programs where, it solves the common problem, whereas very few people or less people than before have these 9-to-5 salary jobs. That used to be the norm 20 years ago. That's what most people had. Now there's hybrid, there's, more people being self-employed. In LA, obviously very much entertainment driven and people bouncing from project to project or job to job. From an underwriting standpoint, that can be very difficult, right? Because there's not always consistency. And most people right now are still dealing with having to show tax returns from 2020, which was the COVID year, the worst of the COVID year, and starting to rebound their business. So that can affect their ability to qualify. So we have a lot of great products that in different ways accomplish an ability to overcome that challenge. So one of the simplest ones is doesn't even require statement of employment or income at all. So if you're recently self-employed, that is generally a very big problem to overcome for a mortgage application. You can use a product like that, for example, to get into the home because you can afford it. You're not putting yourself out. It's just you can't fit into the box that a traditional lender will want you to fit into. So that's one example. Some of our products only require a look at 1 year of tax returns rather than 2. So people, who had a rough year in COVID, which is a very common problem for just about anyone who is self-employed, 2020 doesn't look so good, but 2021 looks much better, right? And within 3-4 months, people start filing 2022 taxes. So maybe they only can show 1 year of tax returns, or maybe they can show bank statements showing the flow of income coming in. But I always say, my grandfather always said, if I had a nickel every time somebody said ... right? Everyone for us says, oh, I'm self-employed, my tax returns don't show my true income, right? We know how that works because you can take all these write-offs. But there are products out there that are great to resolve that issue. And then once you're able to show sufficient income for a more conventional loan, which would have a better rate, you can refinance into that loan. So it's a matter of getting yourself into the home. Obviously, you need to make sure you're comfortable with the payments and that you can afford the property. You're confident enough in your employment situation to be able to make the payments and not default. But if you're confident in that, these products are really great. And then on the investor side, we've got some amazing products that will do, for example, fix and flip. So if people want to buy a property, do a major renovation, and then flip it or potentially rent it, we can finance up to 85% of the acquisition cost plus the renovation cost. So if you have a $2 million budget, we can finance 85% of that as long as the after repair value is at least 30% greater than the mortgage amount that you're looking at. So they'll look at the future value, for example. You can do the same thing on the commercial side. We have private money loans that will allow you to do, for example, value add projects on commercial, where you're coming in to buy a building that's maybe a little, roughed up and not really performing very well. And they won't look at necessarily how it's performing now, but how it might perform once you do the renovation. So, and we have for people who like to flip properties, for example, we have a private money line of credit, which is an amazing product for people who flip, because usually when you flip properties, you're traditionally using private money loans or hard money loans, as they're traditionally called. But every time you do a project, you have to pay new closing costs when you take a new loan, right? So we can do a line of credit if you have an existing portfolio of properties that allows you to finance potentially up to $10 million, and you can go in second or potentially even third lien position. So if you have a really great first mortgage that you don't want to get rid of because you got it when rates were 3-4%, you can leave it alone, which is a big deal. But also, you only pay closing costs when you open the line, which is one time, not every time you're flipping properties. So if you're flipping 5-10 properties a year, or even one property a year, you can keep this line open for usually up to 3 years, and then you can renew it as long as your payment's on time. You can really save a lot of money by doing it and just paying closing costs once. So there's a lot of great products. We pride ourselves on being experts in strategy. The mortgage industry is not known for being particularly interesting and exciting, but this is the interesting side of what we do.
And guys, you can obviously tell that Mark is a wealth of knowledge. And so if you have more detailed questions about any of these products, be it points or interest or how long it takes to complete a file, et cetera, we'll include all of Mark's information at the end so you can touch base with him. Mark, as kind of some last thoughts, I know we touched on the idea of a crystal ball and predicting a bit of the future, which none of us can do. But in your world, is there either, as we move forward, or anything that you would like to share with the audience that you think would be helpful?
Yeah, I think understanding that the opportunity is now, while other people are fleeing or getting nervous. The opportunity is right now, and it's going to be short-lived, because if interest rates drop in 6 to 12 months, all those buyers that are leaving the market now are going to come rushing right back in. It could push prices right back up to where they were or even higher. And now you're back to the bidding wars again. So it's interesting. Buyers they're waiting now because the interest rates are higher, but before they were trying to buy and they couldn't buy because they couldn't compete with all cash, for example. And so they fled the market then. Now they're fleeing the market for a different reason. At some point, you gotta take the leap. And I think now is probably the best time to buy over the next 12 months, where you'll get a deal on a property and then you'll improve your cash flow shortly afterwards when rates decline. So I really think now is an amazing opportunity, either as an investor or as an owner occupant.
It's funny, I feel like I'm at a church revival with how often I'm nodding my head and saying amen inside my head, agreeing with you. So I couldn't have said it better myself. Like I said, everyone, I'll include all of Mark's contact info so you can touch base at any point that you have a mortgage or a finance question. Mark, awesome to see you again. Thanks for sharing.
Thank you, Erik. I appreciate the opportunity to come and talk to you and enjoy all the things that you do.
Guys, as always, this is Erik Brown, your Beverly Hills and Los Angeles real estate agent, sharing with you the best of Los Angeles. Until the next time, signing off.
Bye-bye.